So I'm going to provide two short presentations this evening. I'm going to talk a little bit about the provisioning guidelines for credit unions, and then I'm going to talk about the financial conditions of credit unions. And then my colleague Terry Quinn is going to provide an economic overview of for Ireland for 2018-2019. So I'll kick off in relation to the provisioning guidelines. So just by way of background, we published guidelines for credit unions in April of this year, so April 2018. I suppose in terms of what was the goal or what was the purpose in publishing these guidelines, we are trying or hoping to support credit unions in developing and implementing appropriate provisioning frameworks. And why is that important? And we think provisioning frameworks are vital and very important and are essential to underpin and support the recognition of loan losses as early as possible, the adoption of a conservative and comparable approach to the measurement and recognition of provisions, and appropriate disclosure to members to enhance their understanding of the performance of the loan book. And just finally, by way of background, the guidelines are applicable to all credit unions. So in drafting the guidelines, we were very much informed by the relevant accounting standard, and I just have a little bit of information about that accounting standard on my next slide. So FRS 102 has applied to credit unions since financial year end 2016. I suppose the key concept underpinning FRS 102 is an incurred loss approach to provisioning. The detail is set out in section 11, so that sets out the specific requirements in relation to provisioning. A requirement under FRS 102 is that a provision can only be recognised where there is objective evidence of an impairment, and again a key concept underpinning the standard. The standard does provide examples of what objective evidence would be. They include financial difficulty of the borrower or a breach of the contract or the credit agreement. I suppose it's important to stress that the guidelines are not intended and do not replace the standard. The standard is key and core to your approach to provisioning. And as I say, in terms of drafting the guidelines, we were very much informed and took account of the accounting standard. So I'm just going to talk a little bit about what's covered in the guidelines. So I've set out on the slide the key areas or sections that we have set out in the guidelines. So the first area looks at responsibilities in relation to provisioning in the credit union. And I think we're always keen to stress the importance on clarity on roles and responsibilities around provisioning. So we talk about the role of the board. So the role of the board is that they have ultimate responsibility in terms of the adequacy and accuracy of provisioning set out in the financial statements. In relation to the manager, their role is very much around preparing a policy and a provisioning methodology to be approved by the board. We also touch on the specific role of internal audit, and that is around ensuring that the provisioning framework is implemented as intended. And I think that's a key review function that I have. We also have a section in the guidelines relating to provisioning policy, and we set out what we would expect to see in a provisioning policy. So I suppose I've included some examples today, which would be around setting out what the form and frequency of reporting to the board around provisioning is, setting out detail on the methodology and estimation tools used to calculate provisions, documenting and articulating the approach to loan write-offs and also the approach to income recognition for loans which are in default. The next section of the guidelines looks at assessing impairment. So we talk here about a loan loss occurring where an impairment trigger suggests that there has been an impairment or a change to the expected future cash flows on a loan. So I suppose important to stress that you need both the impairment trigger, and an impairment trigger could be a macro trigger, so it could be a change in the economic environment, it could be a fall in unemployment rate. or it could be a personal trigger. So it could be something like a request from a borrower to reschedule a loan, or a request for a loan, a share to loan transfer, which may be indicative of a change in circumstances and may be indicative that we need to change our expected future cash flows on that loan, therefore indicating that an impairment has incurred. In terms of the next section, it looks at guidelines for the calculation of impairment provisions. So this very much looks at the approach in terms of individual loan assessment and collective loan assessment, and sets out some of our expectations around how that could be approached. And the final section of the guidelines focuses on our supervisory expectations in relation to provisioning. So we articulate that it is our expectation that every credit union has a comprehensive framework in place that should support the recognition of provisions as early as possible. Also stresses the importance of clearly documenting those roles and responsibilities, and that all individuals in the credit union are clear on what their responsibility in relation to the provisioning process is. And we also talk about the importance of appropriate oversight and the role that the board should play in relation to appropriate oversight of the provisioning framework. And as we articulate in the paper, we would see all of those being core to underpinning a very robust and strong provisioning framework. And going back, I suppose, to the points that I set out on the first slide, that will support early recognition of losses, will support an adoption of an appropriately conservative approach, and will support that transparency for membership in terms of understanding the performance of the credit union's loan book. So as I say, that's a very quick overview of the guidelines. They are available on the Central Bank website. We've incorporated them into the Credit Union Handbook, so they've now become part of the lending chapter of the Credit Union Handbook. So that's chapter 13A of the handbook. If people do have questions around the guidelines, we're happy for them to submit them to the email address that I've provided up here. So that's rcu@centralbank.ie. And just to ensure that it gets directed to the right person, if you could mark them as provisioning guidelines in the subject line, as I say, it'll just ensure that the query is directed to the relevant person. So that brings me to my next presentation, which is somewhat unrelated. But this is looking at the financial conditions of credit unions. So this is a publication that we introduced back in 2017. Since its original publication, we have issued 3 editions. The latest edition was issued at the beginning of August of this year. So our goal in issuing this publication is to assist credit unions in analysing their performance relative to the sector and relative to their peer group. It provides important insights in terms of key trends across the sector, and I think that can, as Elaine mentioned earlier, inform discussion and debate at an individual credit union level. The publication itself is based around data that credit unions provide to us. So that's the data that we receive on a regular basis through things like the quarterly prudential return and the annual return that you make to us, and also some of the ad hoc data that we request from time to time. And this information is collated by the registry's analytics team, so they undertake combining and assessing it, and then, as I say, providing the key trends in the paper itself. So our publications to date have covered some core areas. So these will be what I've called on the slide, the recurring theme. So each of them has looked at return on assets, investment, loan and arrears. But each of the publication has also focused in on some specific areas. So for instance, the first edition looked at the specific areas of reserves and reinvestment risk. Our second edition focused in on dividends, new lending, liquidity, savings. And our third edition looked at the loan interest rebate and longer term lending. And also just to note that the second and third edition have included additional analysis. So we've moved to actually break the analysis down, both in terms of common bond type and in terms of asset size of credit union, which I think enhances the usability of the data. So I'm just going to take you through, I suppose, some of the key trends that the publication has identified. So the first, I suppose, slide here in terms of charts is just a a quick snapshot or a quick sector overview. So I suppose this illustrates, I suppose topics that we've talked about before. So the level of restructuring has had a significant impact on the makeup of the sector. So we're now at a situation where 53 credit unions have assets of over 100 million, and the largest credit union in the sector now has assets of over 400 million. I suppose this has been accompanied by an ongoing and gradual increase in member savings. So the period we looked at here is between March 2013 and March 2018. And over that period, savings have increased by 2.7 billion, so taking total assets to 17.2 billion. And as I say, the increase in savings and I suppose the pressure on lending has pressured the loan to asset ratio, which currently stands at 27%. So we've touched on some of these challenges, but I suppose that the paper does serve to highlight some of the challenges that the sector faces. So we've touched already in terms of the loan to asset ratio. We've also touched in terms of, and I know Elaine mentioned this in her opening remarks, some of the pressure on return on assets resulting from the low loan to asset ratio and the low interest rate environment that we currently are in. But there are also some positive trends which are worth noting. One in particular relates to new lending. So when we compare new loans advanced for the 6-month period up to the 31st of March 2018 to the 6-month period up to March 2013, we see a 43% increase in new loans advanced. So in monetary terms, that's 350 million of new loans advanced on a comparative basis. We've also seen a significant reduction in the level of arrears in the sector. So that's moved from 20% in 2013 to the March 2018 level of 7%. And also some positive trends in relation to reserves. The sector has continued to grow reserves. So we're at the stage now, as of March 2018, the majority of credit unions have reserves in excess of 12%, and there are actually a significant number of credit unions that have reserves in excess of 20%. So moving now to look at return on assets. So the trend, I suppose, highlighted in the paper is that fall in return on assets we've talked about. So as of the 31st of March 2013, return on assets was 2%. That has fallen towards 0.7%. And we've talked about some of the key drivers of that. I suppose another one we haven't mentioned is an increase and a gradual increase in costs. So that will be around salary and related expenses, and also relating to insurance expenses. I suppose also interesting to note, I suppose an emerging trend in terms of the difference between annualised overall return on asset and operational return on asset. And I suppose the element that's driving this is provisioning and actually write back of provisions. So I suppose in terms of analysing your performance, we'd certainly stress that operational return on assets is key. That's probably what will tell you your in terms of forecasting where you can likely generate return going forward. So moving then to dividend and loan rebate. Again, I suppose some interesting trends there. There has been a significant fall over the period we looked at in relation to dividends. So we looked at a period September 2012 up to September 2017 here, and the dividend rate or the average dividend rate has fallen from 0.8% to 0.2%. But in contrast, over that same period, there has been an increase in the number of credit unions who are paying a loan interest rebate. So in 2012, about 30% of credit unions were paying a loan rebate. That has increased to 72% by the end of the financial year end 2017. So looking now at lending, and I know Elaine has given us quite a lot of detail in relation to lending, but I suppose just two things I suppose I'd call out here. Again, I suppose we've touched on this, after a period of decline in lending, post 2015, we have started to see an increase in lending. So the growth rate in relation to lending for the year between March 2017 and March 2018 for the sector, or but the average across the sector is 5%. Now, just interesting to note that there is some divergence between credit unions of different asset size. So if we look at credit unions with assets over 100 million, the growth rate for the same period is 8%, whereas if we look at credit unions with assets of less than 40 million, the growth rate in lending is 4%. And I suppose just another trend to notice, and this is illustrated by the graph just there on the right-hand side, is that we are seeing a change in the size of loan being issued by credit unions. So actually a trend in terms of an increase in the size of new lending being issued. So, and then just my final slide in terms of graphs and charts is around investments and liquidity. So investments remain predominantly focused on accounts and authorised credit institutions and bank bonds, but I don't think that's surprising. Like, this chart is looking at March data, and the new regulations only came in at the beginning of March. Again, I suppose unsurprisingly, we continue to see pressure on investment returns given the low interest rate environment. But the chart I've picked out here, just on the right-hand side of the slide, tells us about the composition of sector liquidity. So I suppose an important change was introduced in the new investment regulations back in March. So this allowed for broaden the definition of liquid assets to include government bonds, bank bonds and supranational bonds. So these can now be included in your liquidity calculation, and that's illustrated by that orange box on the top of the second bar there. And if we look in terms of the level of reported liquidity for March 2018, that stood at 44%, and that will compare to 38% if the liquidity was calculated using the older definition of liquidity. So just, I suppose, to point you where the information is available, so you can see the current and previous editions of the financial conditions publication on our website. It's in the communications section, and there's a statistics section within that section of the website. The link obviously will be available when we circulate the slides. Our next publication will be based on September 2018, so year-end data, and we expect to publish December of this year. And just, I suppose, again, to ask for feedback. We're certainly interested in views people have, and potentially, areas that might be useful to cover in the publication. So if anybody has feedback on that, they can provide it to this email address, which is rcuanalytics@centralbank.ie.